Hey guys, this is Simon with ToughTrader.com and Trade and Perform Coaching. Wanted to do a video because something very unique happened on Friday, and that was that we had a trend day down in CL, and we had an attempted trend day down in ES. And one of the clients I was coaching one-on-one was having a hard time believing that we would run back to the upside. And I thought, because they both occurred on the same day, meaning the downside rotations in CL, which is crude oil, and ES, which is the S&P 500, or the spiders if you trade the exchange traded funds. I thought it was a great compare and contrast moment and an explanation as to why people have such a hard time shorting the S&P 500, whereas it works in other commodities. So let's do a quick compare and contrast. Real quick before we get started. Past performance is not indicative of future results, right? There's substantial risk to trading derivatives. You can lose all the money you have. Please, please, please make sure you know what you are doing. Do not blow yourself up. It's totally not necessary. Take the time to learn what you are doing if you'll read this legal notice when you get a moment. Again, I'm sharing my trade plan and my 20 years of trading experience with you in hopes that it'll make you a better trader. My job as the leader of the room and as a one-on-one coach is to help guys get better, sidestep you through the landmines as much as possible. I can't save you from yourself, but I can help you improve as a trader and get over the boom-bust cycle, which so many new traders come into, and then they go, well, this is impossible, right? So if you, on the right-hand side of the screen, what you'll see here is the S&P 500. Or the screen here. This is the oil index, CL for Texas Light Sweet Crude. And you can see that they had very different days, although they both started off in the same direction. So let's go over some compare and contrast. So first of all, crude oil is one single product, right? It's dominated by institutional traders, right? And it's driven by fundamental news. So it can very much go in one direction. It can go straight up, it can go straight down, and when traders get caught out of position, there's no natural inflows and I'm going to contrast that versus the S&P 500. In the S&P 500, you have mutual funds, you have hedge funds, you have pension funds, and wealth management companies, and their mandate is to overall be long or in cash. That's pretty much their choices. And many of them don't even have the be in cash mandate. They require that they be invested up to 90% of their investment dollars. So what you end up with on this side of the equation is a constant and never-ending supply of money coming in and pushing it up. And I'm going to show you this in just a second. Whereas on CL, right, this is a 5-minute chart. But if we look at a bigger time frame chart, like if we go to an hourly, what you'll see there is it can go through periods where it can just go straight down, right? And then it goes through periods as fundamental news is perceived to be changing, where it can go simply straight up with no counter rotation. And frankly, it's why a lot of trend traders prefer trading oil over trying to trade the indexes. You have one product that you're trading versus attempting to trade literally what's in here. On the S&P 500 is 500 individual products that are being averaged and weighted within that index. And the overall assumption is that indexes are going to put money in. And so then what you have to try to do is catch periods of time in order to get a true roll down in the index where it actually goes straight down, where there's actually a fundamental scare, much like what happened in 2008. But the rest of the time, it's hard to get it to go straight down. And I'll show you again. What you see in the S&P 500 is in this, here, I'm going to draw it out for you, is a constant push down, then money comes back in. Push down, right? That looks pretty bad. Money comes right back in. I'm going to keep scanning this. Even when we were looking pretty bad over here, see where it pushes down? Yeah, we had trend day down, but look at the end of the day. They push back up, and then they really launch back to the upside. This is why people who are predominantly long the S&P 500 and can wait for pushes back, yes, they miss the elevator down, but they do not get crunched on the rotation back up, and they have the odds on their side of letting the mechanics of the market play in. So next, let's go to our next thing that we could have looked at that would have given us some distinction as to know when the S&P versus CL was turning. So first we'll start with CL. What was different about CL on Friday? So I will tell you I was down 10 ticks at the end of the day on Friday. And I think I bumped this to an hourly chart, so I'm going to bump this to a more manageable 10-minute chart. And the first thing you'll see is this was the high and low from the 14th, right? So additionally, outside from the high and the low, there's another index that I like to look at, and I like to see before coming into the U.S. Open, which was about right here, what the low in Asia and what the low in London was. And so London had the lower low there. So two things happened. We traded both below London low and below prior day's low. And if you'll notice on most days, we tend not to do that, or that becomes a trap point. So I've put a rule into the room, right? If we're trading below London low and we're trading below prior day's low, in order to keep yourself safe, simply don't take the contra trade there, because this is where you end up with long liquidations, or vice versa, when you end up with big up days. Here, I'll show you the flip side of this. Okay. When you end up with big up days where it just drives and drives and drives. So what you'll see here, like if we look at this day on the 7th, so if you look at 6-6, right, what you'll see on 6-6 in the U.S. session, right, so if you look through here, this is U.S. session, this is 8 a.m., this was the high on the U.S. session, this was the high of the 24 hours, right? And what you'll see there is if you look, when we opened up, first of all, we get above the high in early London. See how we consolidated above? That ended up being the London high right there, and that ended up being London low. See how once we got above London high, we didn't make it up above prior day's high, and as soon as we come into prior day's high, it rejects. But notice that once it consolidates above, it gets hung up and starts pushing. Look how much easier the short is once you trap back underneath prior day's high. I'll grant you, you didn't get the high of the day, right? You didn't get the high trade, but you had a beautiful short side trade once it trapped back in and it traded to the other end of the range. It was a really great trade. So the rule in CL is pretty easy. If we're trading either one of the two, if we're trading above prior day's U.S. session high or prior day's 24-hour high, and you combine one more and you put London high, London low. If we're trading above both of those or below both of those, just don't take the contra trade. It'll save you, right? It'll save you in situations where it starts to trend up and is running either in a straight up line or in a straight down line. And I can show you an endless number of combinations. Again, I'll give you this day right here where we closed, where we were trending up, right? We closed this day out. High of the day, here's low of the day. Notice as long as you don't make it above those two, you get beautiful two-sided trading, and you can trade either side of that range up and down, right? See how this, so I'm gonna draw the line for you so you can see it really clearly. From the 5th, right? There's the line right there. There's the high of the day. Notice we peak above as soon as we close back in. Here I have that line drawn just off. There's the high, right? As soon as we trade back in and underneath, beautiful roll back to the downside, right? But then also notice it never breaks the prior day low, and then you get a beautiful roll back to the upside. It makes trading so easy versus contrasting that to we get below prior day's low, right, which was right here. We get, let me erase these lines so you can see that. It's real simple. Below prior day's low, below London's low. Just don't take the contra side trade. You don't get run over. Yeah, you may have missed a little bounce down here. Skilled traders could have caught it, but we ended up closing on the low of the day. Now, let's go contrast that to ES, right? So this is, in most traders' minds, by the way, what they want when they envision a breakdown. That's what most traders want, and it becomes very, very hard to capture that consistently. Okay, so let's transition. Let's go look at ES really quickly. So on ES, we had a couple pieces that were pretty interesting. First of all, here's prior day's low. So when you looked at the market, you said, hey, we got below prior day's low. So I'm not so worried about Globex high and low as I am about the first hour high and low. So here's 9:30 in the morning. Occurs right here. roughly. And this becomes first hour low. On days where we truly trend down, once we break that first hour low, we do not trap back into it. Okay, what we'll do is we'll come up for a backside test. We may even attempt in, but we immediately get back below, maybe backside test, and then we trend down. It's very rare that we actually get a true trend day down in ES, which is why in the room I stress, if I have to lean on one side of the trade, and you'll see this in my Twitter stream and stock twits and in the videos, look for the longs. You want the easy trade. You want the trade where the options will pay easier, right? Look for the long, okay? And if you look here, there's another couple of key elements that you'll see me repeat over and over and over again in the room. 10-point rotations and 20 to 25-point stretches. So the first thing is, if you look, this is where we closed on Thursday afternoon, 27.88. If I take 27.88 and I remove 20 points from that, that puts me at 27.68. Lo and behold, right? So 20 points doesn't have to work, but man, it's a fantastic location. 20 to 25 points down, and you start searching for excuses to get long. You start looking for your calls, particularly your weekly calls, where you can have huge returns in your capital spent, right? You make a killing. Also, I want you to think about this. Think about two different traders who had no idea about accuracy. They just had an idea about where the ways market generally move, okay? You had one trader who was a short, one trader who was a long. The trader who was a long said, I buy dips and I wait patiently. I trade instruments, or I have stops that will accommodate rolls against me. And the short trader does the same thing, right? The short trader walks in and he goes, oh, I think we're short. I'm going to short the open. And I am looking, I'm going to press that short because what I'm thinking in my mind is we're below prior day's low. There's so much bad news. How can this thing come back up? Chinese President Trump puts in these Chinese tariffs, right? We're starting trade wars. Politics look crazy. The economy, you read some story that says, oh, things are bad. We're going to zero, right? Give me just a second to kill my alarm. Okay. You look at all of that, you put all of those pieces together and you go, oh my gosh, it's going to zero. And you forget that the underlying way that the S&P 500 is cash inflows, net positive. It's very hard to get it to go in a straight line. So that guy shorts at the open, but then you have the other trader and he says, I like buying every 10 and 20 points down. Now I'll tell you what we did in the room. I kind of goofed the trade on Friday. I did not take an S&P futures trade Friday because I have a hard time trading on quad witching. I have a belief that I need to examine. But what I was willing to do is put a limit on my risk, and I bought the 277 calls, the Spider 277 calls for 14 cents a piece. 14 cents a piece. And I bought them horribly, quite frankly. I bought them right here where I thought we weren't going to be able to push any lower, and I made a mistake, right? I bought them, and then we instantly, as soon as I bought them, dumped another 10 points, right? Things look pretty bad for me. Things look pretty good for the short seller. Short seller starts celebrating and thinking, we're closing at the low of the day. He's over there looking at the oil chart, and he's thinking, this is what I'm going to get right here, right? He's thinking this picture, straight down, annihilation, I'm going to be rich, right? I'm thinking S&P 500 usually turns. I'm looking for good locations, right? I put my risk in here on the options, right? We come and roll all the way down. I get a long signal right at the low. I totally ignored it. As a matter of fact, the I ignored it, and and we got a trigger right at the low. Here, I'll show you. The stars are the trading triggers, and I totally ignored my long right off the low. Here, I'll show you. I get a star to the long side right off the low, and I ignored it. I have a second algo that triggered the same location for a long, and I ignored it, and I didn't add to my futures trade, my options trade. But let me tell you what was important here about the day. Okay, so when you come back over and you look at this chart, all right, yes, I was underwater, and I even got so disgusted at myself that I didn't buy the low, that I left, and I figured, I kind of got bummed out. I kind of figured, well, I'm out of luck. It's not going to counter rally. And I actually went to my house to cook myself some lunch and kind of forgot about the trade. And lo and behold, look at the nature of what happens here. We grind, we grind. What we're doing here in the S&P 500 is we're collecting shorts. Everybody who's bearish is shorting in here. They're looking at this going, we're going to roll lower. And guess what happened right here? With about an hour to 2 hours to go in the day, everyone said, oh, we're not going down, which is not a shock if you know about the S&P 500 and how it works. We rally. These calls that I bought way early in the day had a one-day expiration. I paid 14 cents for them. Rallied as high when we were up here at the high over here to over 50 cents per contract. It was a triple, right? At one point, I ended up selling them for 40 cents a contract, which is more than a double, right? So 14, 28, almost 115, almost 150% return on those options, right? Why did that work for me? A, I don't try to force the short. I scalp to the short side and I cover. B, I don't drink the bear Kool-Aid in the S&P 500 ever. Why? Because it keeps turning up. And I'm going to show you this because I think it's so important. I'm going to go to a 30-minute chart, and I'm going to demonstrate this to y'all because I want you to stop losing money. I care about your trading, right? The reason why I do this is I care about traders. If you want markets that can go straight down or straight up, go trade something besides the S&P 500, okay? So if you look at the S&P 500, right, look at all the down days. My challenge to you would be this. Go count all the down days where we close even within a hair of the low, where we can even close within 4 points of the low of the day. Go try to find them. They're very rare. Gap downs, right? Close all the way back up. Roll downs on the 24th, close all the way back up. And you can say, well, Simon, what about earlier in the year when we were in what about the February period where we were just getting hammered to the downside? Fine. Let's go look at that. Well, what stands out to me immediately is the 21st of February. It closed on the low. But guess what? Look at all the other days, right, where we didn't close. This is a down market. I want to show you this. We just rotated down here. I want to make this point so that people will gain confidence in looking for longs. In this whole down rotation, the 27th closed near the low, right? I'm going to show you that. The 28th closed near the low, right? The 1st closed near the low. Now, after that, and hell, we'll even throw in this right over here. The 21st closed near the low, and even the 20th. Okay, now I want you to look at all the days before that, right? If you were celebrating those closes near the low, look at all the days where we gap down or attempt to push down, and we close nowhere near the low the gross majority of the time, the 6th. Okay, so on the 2nd, we closed near the low. We truly had a few trend day downs in that period, but very, very, very few. The majority of the time, when you look at these days, what you're going to see is giant U-turns off the lows. And even on days where we do close near the low, and again, I want to show you this. On days where we do close near the low, like on March 23rd, look at the next day, massive counter rotation. We close near the low on the 2nd. By the 3rd, massive counter rotation. We close even near the low on the 6th. Next day, massive counter rotation. What I'm trying to say is even in a bear market, even in a down market, the S&P 500 goes back up. Either find a way via using options, right, or using futures, and then have a methodology for identifying the bottom, right, and look for the U-turn in the S&P 500 because that's what the S&P 500 does. Shorts are harder than longs in the S&P 500, right? Until something changes fundamentally. That's been true for the last 35, 40 years. So you can be the one to find the top, right? But you can see even on days where we were rolling down, look how many U-turns come out of the process of rolling to the lows. A lot of U-turns come out of there. I won't say that we can't have good down days, and I love to short when the market's breaking down off of rallies back up. But I do not look to short in the hole. It's dangerous. Or your other option is pretty easy. Go learn oil, right? Figure out what your risk is in oil. Oil does tend to go straight up, and it does have many days when it goes straight down, and you can make a lot of money if that's what you need. If you need conviction and you need it to keep going in one direction, oil is much more your product versus the S&P 500. I do not recommend oil for most traders. There's a lot of ins and outs, and it can be very, very tricky to trade oil. And if you're scared to lose money, you definitely should not be trading oil because it can be whippy and it does crazy Ivans. But when it goes in one direction, it goes in one direction, where the S&P rarely does that. So I hope that helped. My name is Simon. I coach traders one-on-one, and I run the Tough Trader Room. If you're interested in visiting us and seeing what we do in the room, we had a great week last week. Send me an email, tradertough@gmail.com. I'm happy to have you. I am out of here. I'm going to have a good weekend. I'll talk to you guys later. Thank you for joining.